Hi everybody, this is Chuck Gibson from Financial Perspectives with my monthly market recap for June 2015. In this video, I'm going to take a quick glance at market returns and U.S. sector performance, followed by world stock indexes, then on to the U.S. bond market, and then wrapping it up with commodities. This month I have too many charts and too little time, so let's get started. As you can see in my first chart, most markets for the second quarter were down, except for U.S. small cap stocks. For the most part, the second quarter's decline wiped out most of the gains that were made in the first quarter, with the notable exception being U.S. small cap and EFA stocks. Clearly, silver was the big loser for the quarter, falling 5.4%. In the next chart of monthly U.S. sector performance, cyclicals, healthcare, and financials bucked the downtrend, while technology and materials took it on the chin. If you haven't noticed, healthcare has been one of, if not the strongest sector for many, many months, this month being no exception. And with the Supreme Court upholding the legality of Obamacare, I don't expect to see this change anytime soon. Keep that in mind if you're looking for a home for some of your equity investment dollars and don't currently have any exposure. My next chart is that of the U.S. total stock market and shows how price finally broke down out of the red rising wedge I had been warning about and came down to touch the blue long-term uptrend line. The measured move out of that rising wedge pattern says we likely have further downside to go, so keep that in mind as we move into the slow summer months. With price still within the long-term up channel and momentum in the upper pane bullishly positioned and exhibiting strength, for now, it still looks as if higher prices are likely once this correction ends and we finally break out of this dreadful 6-month consolidation. U.S. small cap stocks is my next chart. You can see it provided a nice breakout buy signal back at the start of the year. That was a good time for investors who had not had an opportunity to jump on the earlier January 2013 breakout buy signal, or those who just wanted to add to their position. I don't like to spend too much time on fundamentals, as I prefer to focus on price. But the underlying strength of small caps is likely to continue if the dollar continues to hold on to its strength. Small caps are typically the big winners under this scenario, as their exposure to foreign currencies is very small as compared to their bigger brothers. The next chart of China's Shanghai Index illustrates what a parabolic move looks like if you have not seen one. The last one I remember being involved with was silver back when it peaked in 2011. The Chinese stock index had a powerful move out of a multi-year consolidation back in August of last year. You can see in the bottom pane how it had been underperforming against the S&P 500 by almost 60% over the prior 4 years. That breakout move erased almost the entire 4-year underperformance in just under a year. That's how strong it was. Parabolic moves are wonderful if you're in them, as you are likely printing money. But at some point in time, they end, and that's usually with a blow-off top, which is typically followed by a rapid decline. Parabolic moves require you to be nimble in order to preserve your gains, because they usually fall very hard, very fast, and they freeze most investors. The recent move out of China was no exception. The fundamentals for a long-term China bull are compelling, but extremely gappy, parabolic investments are very tricky to navigate. Looking ahead, I expect price to retest 3,400 and maybe even lower in order to completely unwind the massively overbought conditions and shake out the remaining weak hands. It would not surprise me, though, once it is complete, to see this take another run and make all-time highs. The next chart of the emerging markets is a great example of a market that's in consolidation. As such, it's nothing we want to have anything to do with, and won't be interested until it can break out above the upper red resistance channel line. As trend followers, your goal is to only own things that are trending and avoid those investments that are consolidating. Obviously, there's just no way to make money if prices chop around sideways in consolidation mood, so there's no reason to own it. In the bottom pane, you can see since the fourth quarter of 2010, the emerging markets performance has lagged that of the S&P 500 by more than 60%. At some point in time, this will be a great investment opportunity, but that time is not now. It does, though, have a permanent home on our watch list. To wrap up the discussion on the equity markets, my next chart is that of EFA, which includes the developed countries in Europe, the Far East, and Australia. While this market has been in an uptrend, you can see in the bottom pane it has underperformed the S&P by almost 30% for the 4 years that included 2011 through 2014. You'll also notice the bounce that began in January of this year marked a bottom in both price and performance comparison against the S&P, which was significant. Since that time, it formed a double top in May and has drifted lower since, likely held at bay by the Greek default drama. In spite of its recent outperformance and being from Missouri, I remain skeptical, but I'm willing to be shown the way if I'm wrong. Until then, I will keep client exposure at its current levels, which is just a token allocation to ensure portfolio diversification. Moving on to bonds, the next chart is a look at the 30-year U.S. Treasury. We were warned back in March that a correction was imminent, which is why we sold half of our position, and the market didn't disappoint. What surprised me, though, was how hard it fell, slicing right through the area of major support. The bottom line here, folks, is we are at a critical juncture right here. This has my attention and should have yours if you're a bondholder. You can see we bounced off the long-term uptrend line last week, which is a positive sign. But if that doesn't hold, it will signal the intermediate-term uptrend has ended, and we have likely begun a new downtrend, with the first target being 142, followed by 135. As such, any such rally should be sold and replaced with shorter maturity investments, or even left in cash. To close out this month's video, I want to look at 4 charts from the commodity sector. The first being the CRB index. While it is a broad-based exposure, as it includes 19 different individual commodities, it is overweighted in energy, so it's important to keep that in mind when looking at the chart, as it tends to mirror the price of oil. What you should notice is since the top in 2008, it has been in a downtrend, falling more than 55%. In the bottom pane, you can see it has underperformed the S&P 500 by more than 70% during this time. It has been an area I have recommended avoiding, except for those nimble traders who are successful at playing short-term counter-trend bounces. One interesting item of note that I need to point out, even though it is likely insignificant and uninspiring, is we have formed a sloppy inverse head and shoulder pattern since January this year, which portends to a potential reversal to the upside trade. Sadly, the upside target from that move maxes out at 20 points, or just slightly less than 10%. Now on to oil. The next chart is that of the daily West Texas crude pricing. After the divergent oversold buy signal in March, we moved higher as expected, but have since stalled out and been in an area of consolidation. Using the red 200-day downward sloping moving average as my guide for current trend, I expect the move out of this consolidation to be a continuation to the downside, which will disappoint those investors who are long oil, but should bring happiness back to the gas guzzlers and gas pump visitors everywhere across the U.S. My last 2 charts are both interesting, as they point out to potentially big moves on both. First, let's take a look at silver. I have consistently been warning of lower prices ahead, and it looks like we may soon be close to opening up the trapdoor below once again. I find it interesting to look at how during this entire downtrend that price patterns continue to repeat themselves. Once again, we're in an area of consolidation and have bounced off a blue support line for the 4th time. As a general rule, the more times price hits a level, the greater the chance of breaking through. And as such, I expect to see silver break down here anytime soon. The downside target on this pattern is about $12. I would expect this to create the final flush for precious metals, setting up for a major bottom and a potential new bull market. If that's the case, $12 is probably a very optimistic target, as final flushes like blow-off tops can go much further than anyone expects. On a more positive note, let's take a look at my final chart. What we saw in the last week of June was a breakout in high volume buying in the agricultural commodities, like wheat, corn, and soybeans. The next chart is that of wheat, which happens to be the best looking one from a technical standpoint, and one that I am personally invested in. You can see the price of wheat has been in a severe downtrend, falling more than 65% from its top in 2008 to its recent bottom. What you should also notice is just recently, price broke above the red horizontal resistance line with gusto in high volume, which is shown in the bottom pane. The reason for my interest is that the latest move has the potential for being a major reversal rather than just an oversold dead cat bounce. If your eyes have looked at other areas of this chart, you should notice the blue shaded area where price bounced off the low and moved higher by 30%, only to give all that back and then some. Hopefully you're thinking, what makes this current move have the potential to be a trend reversal and the prior move didn't? We all know that uptrends are defined by higher highs and higher lows, which I have highlighted with blue horizontal lines, showing each successive high was higher than the last, as were each successive low. Well, so was the last move in blue, so what makes this one any different? If you remember when I was talking about oil above, I look at the 200-day moving average line in red for an indication of direction. If its slope is pointing up, then the current trend is up, and vice versa. You can see the current 200-day moving average line has just turned tail and is now sloping up, whereas in the prior blue bounce, it was sloping downward. In addition, and very importantly, price has moved above the 200-day moving average. That, folks, is the difference. I rarely enter long-term positions without having both a rising 200-day moving average slope and the price above the 200-day moving average line. Well, I'm running really long here, so let's call it a wrap. As always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with the June Monthly Market Recap.